Disclaimer.
3 trading days. That's how long it took for silver to collapse by over 30% in the worst precious metals crash since 1980, exposing the most dangerous vulnerability in our monetary system. On Thursday, January 30th, 2026, President Trump nominated Kevin Warsh as the next Federal Reserve Chairman. The following day, Friday, January 31st, silver plunged 27% in a single session. By Monday, February 3rd, it had fallen another 6%, bottoming out near $77 per ounce. If you owned silver or silver mining stocks during those 3 days, you watched your wealth evaporate faster than at any point in over 4 decades. Here's what should grab our attention. This wasn't a natural market correction. The collapse was triggered by a single political event, the Warsh nomination announced on Friday morning. One personnel decision in Washington and the entire precious metals market imploded. Think about what that reveals. Our so-called safe haven assets, the investments we're told to hold when everything else fails, can be devastated by who gets appointed to run the Federal Reserve. But while investors panicked and financial media rushed to explain the crash, something else is scheduled to happen 7 months in the future that almost nobody's watching. Texas has a plan, and it goes into effect September 1st, 2026. You probably didn't hear about House Bill 1056 when Governor Abbott signed it into law on June 22nd, 2025. It didn't make national headlines. Financial networks weren't analyzing it during prime time. But this piece of legislation represents the first serious challenge to the Federal Reserve as monetary monopoly in over a century, and the implementation timeline is already running. Here's what Texas just authorized: a state-backed digital precious metals payment system, not some speculative cryptocurrency, not a regional payment network. We're talking about a constitutional framework that allows Texans to conduct everyday transactions in gold and silver instead of Federal Reserve notes. Buy groceries with silver, pay your mortgage with gold, receive your salary in precious metals if you want to. The infrastructure is already being built through the Texas Bullion Depository, a state-run facility in Austin that stores over $1 billion in physical gold and silver. By May 1st, 2027, according to the implementation timeline written into the law, Texans will be able to use a digital interface linked directly to their bullion holdings. Swipe a card or tap your phone, and you're spending actual precious metals while the seller receives dollars if they prefer. The conversion happens instantly, but the key difference is this: you're not using dollars as your base currency anymore. You're exiting the Federal Reserve System entirely. Now, you might be thinking this sounds like some fringe monetary experiment that only applies to a handful of gold bugs in Texas. Let me put this in perspective. Texas has the 8th largest economy in the world, larger than Canada, larger than Australia. Its GDP exceeds $2.4 trillion annually. When an economy that size creates legal infrastructure to bypass Federal Reserve notes, that's not a curiosity. That's a direct challenge to the foundation of our monetary system. And Texas isn't alone. Florida passed similar legislation on May 27th, 2025, with implementation scheduled for July the 1st, 2026. So did Wyoming, Oklahoma, Arkansas, Missouri, and 11 other states, each one creating the legal framework for precious metals as payment, each one building infrastructure to compete with the Fed's currency. According to polling data from Texas Republican primary ballot Proposition 7 in 2024, 76% of voters supported these measures. This isn't a fringe movement anymore. It's mainstream sentiment manifesting as state policy. But here's where it gets really interesting, and this connects directly to that 3-day silver massacre we started with. The crash happened because Kevin Warsh's nomination represented something unprecedented in modern American monetary policy. A president openly pressuring the Federal Reserve while simultaneously maintaining a criminal investigation against the sitting Fed chair. Jerome Powell, the man currently running our central bank, has been under Department of Justice investigation since January, with grand jury subpoenas served on January 10th regarding his congressional testimony about Federal Reserve building renovations, all while Trump is trying to replace him with someone who has recently advocated for lower interest rates. Think about what that means for confidence in the dollar. The entire foundation of central banking depends on the belief that monetary policy is insulated from political pressure. That's the theory, anyway. The Federal Reserve is supposed to make decisions based on economic data, not White House preferences. But when a sitting president can maintain a DOJ criminal investigation of the Fed chair while nominating his replacement, that theoretical independence evaporates. And precious metals are the only asset class that benefits when that independence is questioned. That's why silver shot up to those record highs right before the crash, reaching levels above $110 per ounce in late January. Investors around the world were watching the Fed's authority being challenged in real time, and they moved capital into the oldest form of money humanity has ever known. Not because silver has industrial uses, though it does. Not because of supply and demand fundamentals, though those matter too. They bought silver because when you can't trust the people managing your currency, You need something they can't print, something they can't manipulate, something with 5,000 years of history proving its value. Then Warsh got nominated on Friday morning, and by Monday, the paper-silver market had collapsed over 30%. You need to understand what actually happened during that crash, because it reveals the mechanism that Texas is about to exploit. Silver trades in two markets. There's the physical market, where real metal changes hands, bars, coins, bullion sitting in vaults. Then there's the paper market, where contracts representing silver get traded back and forth. The paper market is enormous. According to data from the London Bullion Market Association, paper-silver contracts represent roughly 250 times more volume than actual physical silver available for delivery. Let that sink in. For every ounce of real silver that exists and could be delivered to you, there are 250 paper claims on that same ounce. The entire system works as long as everyone agrees to settle in cash rather than demanding physical metal. It's a massive leverage game built on the assumption that only a tiny fraction of people will ever want actual delivery. The Warsh crash happened because major players holding those paper positions decided to exit all at once. They weren't selling physical silver they owned. They were closing leveraged contracts, and the cascade of selling triggered algorithmic trading systems that amplified the move. Within hours, retail investors watching the price plummet hit their stop losses or got margin called, forcing them to sell at the worst possible moment. The professionals who engineered the move bought back their positions near $77, pocketing billions in profit. By Wednesday, February 4th, silver had already recovered to nearly $90 per ounce as the dust settled and buying resumed. And do you know who didn't get hurt? Anyone holding physical metal. If you owned actual silver coins in your safe or bullion in a private vault, your metal didn't disappear. You still had the same number of ounces. The paper price crashed, but the physical reality remained unchanged. That's the lesson Texas is betting everything on. When the paper system breaks, not if, when, physical precious metals become the only legitimate store of value. And Texas just built the infrastructure to let 50 million people access that system legally, instantly, and with state government backing. September 1st, 2026 is 7 months away. That's when the legal framework activates. That's when Texas officially recognizes gold and silver as legal tender under Article 1, Section 10 of the United States Constitution. The provision that says no state shall make anything but gold and silver coin a tender in payment of debts. Most Americans have never read that clause. It's been functionally dead since 1933, when FDR confiscated privately held gold and took our currency off the gold standard, but it never got repealed. It's still in the Constitution, and Texas just decided to enforce it. Here's your wake-up call. The silver crash that just wiped out over 30% of paper positions in 3 trading days is not the end of this story. It's the opening move. Warsh's nomination on January 30th was designed to restore market confidence and signal a more traditional Fed approach. But the crash itself proved why states are building these alternative systems in the first place. Because when your monetary authority can be threatened by criminal investigation, when your Fed chair can face DOJ subpoenas while sitting in office, when a single personnel announcement can trigger the worst precious metals collapse in 46 years, you need a backup plan. Texas just built one, and 7 months from now, it goes live. 820 million ounces. That's how much silver the world has consumed beyond what it produced over the past 5 years, draining inventories to levels not seen in decades, while creating the foundation for what may become the most severe precious metal supply crisis in modern history. According to the Silver Institute's 2025 World Silver Survey, the market has recorded deficits every single year from 2021 through 2025. The cumulative shortfall totals roughly 820 million ounces, nearly equivalent to Mexico's entire annual production, which stands as the largest in the world. In 2025 alone, the deficit reached between 95 and 117 million ounces, depending on methodology, marking the 5th consecutive year where demand outpaced supply despite silver prices more than doubling. Think about what that means. For 5 straight years, humanity has consumed more silver than mines produced. Where did those missing ounces come from? They were drawn from above-ground stockpiles, exchange warehouses, bank vaults, private hoards accumulated over decades. Those inventories are now approaching depletion, and there's no easy way to replace them. But here's what makes this different from typical commodity shortages. The deficit isn't narrowing, it's accelerating. And on January 1st, 2026, China implemented export restrictions that fundamentally changed the global supply equation. China doesn't mine the most silver, Mexico does, but China controls something far more valuable, refining capacity. According to data from the London Bullion Market Association, China dominates 60 to 70% of the world's refined silver supply through its massive processing infrastructure. While the country ranks second in mine production, it has spent 2 decades building the refineries that turn raw ore into the finished metal that solar manufacturers, electronics companies, and electric vehicle producers actually need. Under the new export control regime that took effect 4 weeks ago, only 44 approved companies, large state-aligned entities with annual production exceeding 80 tons, and credit lines above $30 million can export refined silver. The hundreds of smaller and mid-sized refiners who previously supplied global markets are now effectively locked out. Every shipment requires government approval. Every destination gets scrutinized. Every use case gets evaluated for alignment with Chinese strategic interests. This isn't unprecedented. China used the exact same playbook with rare earth minerals, where export controls gave Beijing pricing power and industrial leverage over Western technology companies. But silver is different. Rare earths, power-specialized applications in defense and high-tech. Silver powers everything, from the solar panels needed to meet climate targets, to the circuit boards in smartphones, to the contactors in electric vehicles. When you control 60 to 70% of refined silver at the moment global inventories hit historic lows, you're not just influencing a commodity market. You're holding a chokehold on the entire energy transition. Texas and the other states building precious metals. Payment systems are betting that this supply crisis forces a fundamental repricing of physical silver away from paper contracts. They're positioning themselves to benefit when the leverage game breaks. But to understand why they're so confident, you need to see what's actually driving demand. Solar manufacturing consumed approximately 142 million ounces of silver in 2023, representing about 14% of total global usage. By 2024, that figure jumped to over 190 million ounces as installations accelerated worldwide. Each photovoltaic panel requires roughly 20 grams of silver paste to create the conductive grid that captures electrons when sunlight hits the silicon cells. There's no easy substitute. Silver's electrical conductivity is unmatched by other metals at comparable cost points. And the technology is getting more silver intensive, not less. The industry is rapidly shifting from traditional perky solar cells to more efficient designs like TOPCon and silicon heterojunction cells. These next generation technologies use 1.5 to 2 times more silver per gigawatt of capacity because they require conductive material on both the front and rear surfaces instead of just the front. According to forecasts from Oxford Economics Research for the Silver Institute, solar demand alone could reach 10,000 to 14,000 tons annually by 2030, consuming between 29 and 41% of global supply. Let that sink in. A single industry could absorb nearly half of all silver production within 4 years, and that's before accounting for any other uses. We're not talking about speculative demand that evaporates when sentiment shifts. This is structural consumption where manufacturers either get the metal or their production lines stop. Electric vehicles tell a similar story. A traditional internal combustion engine car uses about 15 to 28 grams of silver in its electrical systems. A hybrid vehicle uses 18 to 34 grams. A fully electric vehicle uses 25 to 50 grams, nearly double. Silver appears in battery management systems, power electronics, charging infrastructure, and countless electrical contacts throughout the vehicle. As the automotive industry shifts toward electrification, silver demand from this sector alone is projected to triple by 2030. Then there's artificial intelligence and data center expansion. The servers processing AI workloads, the memory chips storing training data, the networking equipment connecting everything, all of it requires silver for reliable electrical connections. The electronics sector consumed over 445 million ounces in 2023, growing 20% year over year. That was before the AI boom really accelerated. When you add up solar, electric vehicles, electronics, 5G infrastructure, and traditional industrial applications, global silver demand reached approximately 1.24 billion ounces in 2025. Total supply from mining and recycling came to about 1.01 billion ounces. That's a shortfall of 230 million ounces in a single year, equivalent to Mexico's entire output. Now layer in China is export restrictions, cutting off 60 to 70% of refined supply from global markets. What you're witnessing is the transformation of a commodity market into a geopolitical weapon. And Texas just built infrastructure to bypass the entire system. While Washington debates monetary policy and global supply chains fracture, 13 states have passed legal tender legislation recognizing gold and silver as constitutional money. Florida's law goes into effect July 1st, 2026. Texas activates September 1st. Arkansas, Missouri, Wyoming, Oklahoma, Louisiana, Idaho, Alabama, Utah, and several others have similar frameworks either implemented or advancing through legislatures. Each state is invoking Article 1, Section 10 of the United States Constitution. No state shall make anything but gold and silver coin a tender in payment of debts. That clause has been dormant since 1933, but it never got repealed. The legal foundation existed all along. What's different now is states are building the actual infrastructure, depositories, payment systems, electronic platforms, to make constitutional money functional for everyday commerce. This isn't coordinated by some central authority. These are parallel movements happening independently across states, but with remarkable consistency in their approach. They're recognizing the same constitutional authority, building similar technological solutions, and targeting the same implementation timeline, all within the next 12 to 18 months. The Republican Party of Texas included this as Plank 32 in their official platform, when they put it to voters as Ballot Proposition 7 in the 2024 primary. The Texas legislature should establish authority within the Texas State Comptroller as office to administer access to gold and silver through the Texas Bullion Depository for use as legal tender. 76% voted in support. That's not fringe. That's mainstream Republican voters in America, is second largest state saying they want an alternative to Federal Reserve notes. Why now? Because the conditions that make precious metals attractive as money, currency instability, inflation concerns, loss of confidence in monetary authorities, are converging with the worst silver supply crisis in modern history. States are essentially front-running what they see as an inevitable breakdown in the paper-silver market. Remember that 250-to-1 leverage ratio we discussed in Part 1? That's the London Bullion Market Association's paper contracts compared to physical silver available for delivery. The system works as long as only a tiny fraction of contract holders demand actual metal. But what happens when state-backed payment systems representing 50 million Texans and 23 million Floridians start requiring physical delivery for their bullion-backed transactions? The math breaks immediately. COMEX registered silver inventories, the metal actually available for delivery, currently sit around 50 million ounces. That's down 70% since 2020. Texas GDP is $2.4 trillion annually. If even 1% of economic activity in Texas shifted to the new precious metals payment system, that would create approximately $24 billion in annual transactions. At current silver prices around $90 per ounce, that's roughly 270 million ounces of demand, more than 5 times the entire registered COMEX inventory. And that's just Texas. Add Florida with its nearly $1.5 trillion economy. Add the other 11 states with similar legislation. Suddenly you're looking at potential demand that completely overwhelms the available supply of deliverable metal. The Federal Reserve can print dollars, the Treasury can issue bonds, but nobody can print silver. Mine production is essentially flat, constrained by declining ore grades, and the fact that 70% of silver comes as a byproduct from copper, zinc, and lead mining, meaning higher silver prices don't automatically stimulate more production. Recycling helps, but can't close a 230 million ounce annual deficit. And now China has shut off 60 to 70% of refined supply from international markets, just as industrial demand accelerates. Texas isn't betting on silver going up because of speculation or inflation fears, though both may play a role. They're betting on a mathematical inevitability. When demand for physical metal exceeds available supply by orders of magnitude, the paper price becomes irrelevant. What matters is who actually holds the ounces. That's why the Texas Bullion Depository exists. That's why the digital payment system launches May 1st, 2027. That's why 13 states are building parallel monetary infrastructure, while the silver market records its 5th consecutive deficit, and China weaponizes the supply chain. They're not trying to compete with the Federal Reserve on monetary policy. They're preparing for the moment when the difference between paper promises and physical reality becomes too obvious to ignore. And based on the supply-demand fundamentals, that moment might arrive sooner than anyone in Washington wants to admit. 7 months. That's how long until Texas activates the most significant challenge to Federal Reserve monetary dominance in over 90 years. And the mathematics behind what happens next aren't speculation. They're inevitable arithmetic that nobody in Washington wants to acknowledge. September 1st, 2026 marks the date when Texas officially recognizes gold and silver as legal tender under state law. Florida's system goes live July 1st, 2 months earlier. Between them, these two states represent over 70 million Americans and combined economic output exceeding $4 trillion annually. When their precious metals payment systems become operational, they won't be making a political statement. They'll be creating demand for physical silver that the current market structure cannot possibly satisfy. But here's what makes the timeline critical. We're not starting from a position of market equilibrium. We're starting from the 5th consecutive year of structural deficit. With cumulative shortages of 820 million ounces, Chinese export controls choking off 60 to 70% of refined supply, and COMEX registered inventories sitting at historic lows after plunging 70% since 2020. The silver market isn't healthy. It's already broken. Texas is about to prove it. Let's start with where we are right now on February 4th, 2026. Silver is trading around $89 to $90 per ounce after recovering from the 3-day crash triggered by Kevin Warsh's nomination. But here's what most investors don't realize. That crash was artificial. It was paper contracts getting liquidated while physical metal never moved. Within 2 weeks, the price recovered most of the losses because actual supply-demand fundamentals haven't changed. And those fundamentals are about to get a lot more interesting. Citigroup just published one of the most aggressive silver forecasts from a major financial institution in decades. According to their analysis released in late January, silver could reach $100 per ounce by March, that's next month, and potentially hit $150 within 3 months. Their rationale isn't based on speculation or monetary policy shifts. It's based on the acute shortage of physical silver that's becoming impossible to ignore. BNP Paribas sees a similar trajectory, with analysts including Felipe Geisels stating publicly that $100 per ounce by the end of 2026 is certainly possible, given current supply tightness and industrial demand trends. Bank of America's 12-month target sits at $65, which sounds conservative until you realize that represents multiple times the price silver traded at just 2 years ago. Even their more measured forecast acknowledges the structural deficit persisting through the end of the decade. But these are conservative targets compared to what happens when state-level monetary competition activates, because the analysts making these forecasts aren't accounting for what Texas and Florida are about to do. Texas has a $2.4 trillion economy. That's larger than most countries. It's the 8th largest economy on Earth. Right now, 100% of that economic activity uses Federal Reserve notes, dollars backed by nothing but government decree and the Fed's credibility. Starting September 1st, Texans will have a legal alternative. They'll be able to conduct transactions in gold and silver stored in the state-run bullion depository, with instant conversion to dollars at point of sale if the merchant prefers. The question isn't whether some Texans will use this system. The question is what percentage. And the answer doesn't need to be large to break the silver market entirely. Let's run the numbers conservatively. If just 1% of Texas's economic activity shifts to precious metals transactions through the state depository system, that creates $24 billion in annual demand. At current silver prices, around $90 per ounce, $24 billion equals approximately 267 million ounces of silver per year. Remember that number? 267 million ounces. That's more than the entire global supply deficit for 2025. That's more than all of Mexico's annual production. And that's just 1% of one state's economy. Now add Florida, which activates 2 months earlier. Florida's GDP exceeds $1.5 trillion. 1% of Florida, is economy transitioning to precious metals, creates another $15 billion in annual demand, roughly 167 million ounces at current prices. Texas plus Florida, at just 1% adoption each, creates demand for over 430 million ounces annually. The entire world mined only 813 million ounces in 2025. You're looking at potential state-level demand that could consume more than half of global mine production, and that's before accounting for any other use case. No solar panels, no electric vehicles, no electronics, no investment demand from any other source. But wait, it gets worse for the paper silver market. Because this isn't investment demand that can be satisfied with cash settlement. State-backed payment systems require actual metal. When a Texan swipes their precious metals debit card to buy groceries, the Texas Bullion Depository needs physical ounces to back that transaction. Paper promises don't work. ETF shares don't work. COMEX contracts that settle in cash don't work. Only actual silver sitting in a vault satisfies the requirement, and the vaults are nearly empty. COMEX registered inventories, the silver actually available for delivery on futures contracts, currently total under 50 million ounces. That's down from over 170 million ounces in 2020. If Texas activates with even a fraction of the adoption we're discussing, they'll drain COMEX registered silver in a matter of weeks. Not years, not months, weeks. What happens when registered inventory hits zero? The paper price becomes meaningless. Physical silver starts trading at whatever premium buyers are willing to pay for actual delivery. We've already seen hints of this dynamic. During January's rally before the Warsh crash, silver briefly touched $120 per ounce, while paper contracts lagged behind. That spread between physical and paper prices will become permanent once states start requiring delivery. This is why Citigroup's $150 target isn't crazy. It's actually conservative if state-level adoption reaches even 2 or 3% of economic activity. At $150 per ounce, Texas's 1% still creates 178 million ounces of annual demand. The math doesn't change enough to restore equilibrium. You'd need silver prices somewhere north of $300 per ounce before demand destruction kicked in at levels that might slow adoption. And here's the mechanism that makes this checkmate for the Federal Reserve. They can't print silver, but they have to respond to dollar weakness. If precious metals start replacing dollar transactions in any meaningful volume, the Fed faces an impossible choice. They can raise interest rates to defend the dollar's value, which crashes the economy and triggers political backlash. Or they can accept dollar devaluation, which accelerates the flight into precious metals and validates Texas's entire strategy. Kevin Warsh's nomination on January 30th was designed to solve this problem before it starts. By appointing someone perceived as more hawkish, more traditional, someone who would restore Fed independence and push back against political pressure, Trump was trying to reassure markets that monetary policy won't be weaponized. But the criminal investigation of Jerome Powell, ongoing as we speak, undermines that message completely. You can't simultaneously prosecute the sitting Fed chair and claim you're protecting institutional independence. That contradiction is why silver crashed 30% in 3 days and then recovered most of those losses in 2 weeks. The market doesn't know whether to believe the reassurance or the threat, and that uncertainty is precisely what drives people toward constitutional money that can't be manipulated by whoever controls the Federal Reserve. September 1st, 2026 is the breaking point. Texas goes live with legal tender status. The Comptroller's Office has had over a year since the law was signed to build the infrastructure. The Texas Bullion Depository is operational. Vendors have been selected. The regulatory framework is complete. When Texans wake up that morning, they'll have a choice that hasn't existed in America since 1933. Use Federal Reserve notes or use constitutional money backed by physical metal. The first month will be slow. Most people won't even know the option exists. But as word spreads, as news stories cover the new system, as influencers demonstrate how it works, as early adopters share their experiences, adoption will accelerate. Not to 50% or 30% or even 10%. Even at 2 or 3% adoption, you're creating demand that exceeds global supply by hundreds of millions of ounces. And when Texas proves the system works, every other state with similar legislation will accelerate implementation. Arkansas, Missouri, Wyoming, Oklahoma, they're all watching Texas to see if this actually functions at scale. If it does, the model spreads nationwide within 2 years. You could be looking at 10 to 15 states with operational precious metals payment systems by 2028, representing over 150 million Americans, and $10 trillion of economic activity. That's the Fed's nightmare scenario. Not that dollars collapse overnight, not that hyperinflation destroys the currency, but that constitutional money becomes a viable alternative for a significant minority of Americans who choose to opt out of the Federal Reserve System entirely. Once 5 or 10% of the population demonstrates they can conduct normal commerce without Federal Reserve notes, the psychological impact is devastating. The Fed's power rests on the universal acceptance of their currency. Alternative systems undermine that universality. This is why the silver supply crisis matters so much. If Texas tried this strategy with gold, the existing market could probably absorb the demand. Gold trades in much larger volumes, has more above-ground inventory, and doesn't face the same industrial demand pressures. But silver is different. Silver is already in deficit. Supply is already constrained. China already controls most refining. Industrial demand is already accelerating. Adding state-level monetary demand on top of everything else breaks the market immediately. The price targets we're discussing, $100 by spring, $150 by summer, potentially higher if adoption accelerates, aren't speculative bubbles. They're the mathematical consequence of structural shortage meeting unprecedented new demand. When Texas activates September 1st, followed by the full payment system May 1st, 2027, we're not going to see a traditional commodity rally that peaks and reverses. We're going to see a fundamental repricing of physical silver away from paper promises. And the Federal Reserve can't stop it. They can investigate Powell. They can nominate Warsh. They can raise rates or cut rates or leave them unchanged. None of it matters if states successfully demonstrate that constitutional money works for everyday commerce. Because at that point, the question isn't whether the Fed will maintain its monopoly. The question is how many Americans choose to exit the system while they still can. 7 months from now, we'll know if this scenario plays out. Texas isn't bluffing. The infrastructure exists. The legal framework is complete. The political support is overwhelming among Republican voters. All that remains is activation and adoption. The Silver Rebellion starts September 1st. And based on the math, the Federal Reserve might already be too late to prevent it.